this video, I absolutely guarantee you that you will see some gems on things you've never seen or heard before. I'm going to break down every single concept and understanding within market maker models. And I just want to note that everything inside this video is stuff I've learned over the last few years trading market maker models, and I'm dropping it all for free. So I hope you don't take this for granted. Okay, so let's first start with the market maker model template. This is what the formation of a market maker model typically looks like. You'll have your original consolidation, your distribution phase, where you're engineering liquidity, your smart money reversal, which is off of a key higher time frame point of interest, your accumulation phase, which is a low risk buy, and your reaccumulation phase, which is typically the first or slash second stage entry. Now, if we move over onto this slide, we can see I've gave a blank chart here of a market maker model, and I just want you to quickly, depending on if you're a beginner or not, identify the areas of an original consolidation, where the distribution is, where the smart money reversal, and where the accumulation is. If you haven't and you don't want to do that, that's fine. Now, I'm going to show you exactly where they are. So this is your original consolidation, your equal highs, your buy side, your heavily densed area of consolidation. You've got your distribution, which typically taps back into the low of the original consolidation. Your smart money reversal, which has touched a key higher time frame point of interest. Your first accumulation, your low risk buy, where price will seek imbalances, maybe even discount to then, distribute back higher. Now, the first and most important concept, I think, in understanding market maker models is smart money reversals and the SMT that you can get with it. So SMT is a really, really powerful tool. You look for SMT with a correlated or an inversely correlated asset to provide a higher probability smart money reversal. You can see here that as NQ has taken this high, ES hasn't. That's going to give us confirmation, because we can now see that smart money, who is the larger players involved, the institutions, the ones with actual money, they're loading up positions above this high for the drop lower. So we want to be careful when looking at sweeps to see whether they've had SMT or not, right? And SMT is only really confirmed with some kind of continuation PD array, right? In this example, we've had SMT at the lows, and so what we're looking for is a continuation from that, right? Because SMT could form here, but what might happen is price might just go up a little bit and drop back below the lows again. So we need to know for sure, is SMT present and it's confirmed, which is typically done with some kind of PD array like this. We've got an inverse fair value gap here, we've got our fair value gap that we tap back into, and we've got a change in state of delivery. The change in state of delivery is always going to be the consecutive candles. In this case, it's one. But if you imagine this white candle wasn't here, where I've got my cursor, and imagine it was all of these black candles, the change in state of delivery would be on the open of this candle, which closes above on here. Now, neither of these PD arrays is better than the other. They're all exactly the same. They hold the same weight. However, different scenarios will use different ones. Maybe you don't have an inverse. Maybe you only have a fair value gap. Maybe you only have a CISD. However, combining as many as you can together will give you that higher probability scenario. Now, it doesn't matter, yeah. It doesn't matter which one you use. So in this scenario, obviously we've got all three, and at this candle close, we've used all three because, or this candle close, because then it's made the fair value gap, giving us a strong reaction and confirmation. Now, one thing I would note is that I've got written here displacement fair value gap or fair value gaps. If we get a fair value gap coming from a sweep, so maybe we've swept sell side, maybe we've touched into a 4-hour point of interest or something, a daily, If we create a fair value gap out of that, that's a very, very key sign, because that's gonna showcase displacement. Displacement equals fair value gaps. And especially if you're creating a fair value gap over bearish PD arrays, like an inverse CISD, that's really powerful. Moving on, we're going to look at higher probability accumulations and distribution zones. So we're going to mainly talk about this buy side of the curve going up here as we're reaccumulating positions. We want to look for where the reclaimed OBs are. So I'm going to go through all these points. Let's just start with reclaimed OBs. You can clearly see that a reclaimed OB is a previous or prior bearish order block that was closed back above, and we're talking about the open and close prices here. So this is the close price. If we close back above, that now creates our reclaimed order block, which we do touch back into, continue higher, and we do the same thing here again. You can see there are other ones inside this price leg where we've got these consecutive here, which we close above, and this one comes back down into this zone here and continues higher. We even close above this one, but in this candle we close above this and this, so I just use this one to keep it cleaner, right? And we do actually touch back into both at a later time. Now, 3+ overlapping PD arrays. This is a very, very key concept that ICT spoke about very briefly, in that you want to typically have 3 PD arrays to hold your position or to have a higher conviction in your point of interest. For example, here we've got our fair value gap drawn with the lines, we've got our reclaimed OB, we've got an actual OB, we've actually got a breaker too, so we've got lots of things going on in this area. So this exact area here is very high probability for a reaction. Now, we also want to look at other ones, because maybe in this scenario up here we don't have a breaker, maybe we do, maybe we don't, but in this one we've got our fair value gap, we've got our reclaimed order block, and you could argue that there's an inverse on this side of the curve, or maybe there's some kind of lower time frame PD array that's being held inside of this bit here. Like there's typically always 3 PD arrays that you'll find. It's a good habit as well, when looking for your reaccumulation zones to continue higher, to have a PD array from the current curve and the opposite curve. So this is your current curve as you're going higher. It's your continuation PD arrays. It's your fair value gaps, your order blocks, your volume imbalances. It's them PD arrays, right? Like even here. So here's your third PD array. You've got a volume imbalance in there that we close above and we come back and down a touch. Now, the opposite curve PD arrays are going to be your continuations too. You don't want to try and catch reversals, but we'll speak about that later, because you still can, but it takes a bit more skill. So your continuation opposite curve PD arrays are going to be your inverse fair value gaps, like this one down here. They're going to be your reclaimed order blocks, right? Your breakers. And yeah, so inside of your legs in price, as they're coming down into these accumulations, you want to think about lower time frame market maker models. So this chart could be the 4-hour chart, and you want to think about, if you were going to buy this on a 4-hour chart, you wouldn't want to put your stop down here, because it might take days to hit take profit. So this is where you're going to use lower time frames, right? So fractal market maker models inside of market maker models. I've tried to make this as clear as possible, where this is the exact same chart. I have not used different charts for this. I swear, this is the exact same chart. So here is your 4-hour chart, where, in fact, I can prove that as well. But this is your 4-hour chart of the price coming down into your 4-hour gap. On the lower time frame, the 5-minute, this is how price looks. You can see that we get the exact same pattern in price. Like, look at this. We create equal highs, our buy side. We've got our first stage of distribution, smart money reversal, accumulation, second stage, right? Here we've got our SMT with ES. We've got our fair value gap created. We've got an order block, an inverse, we've got a breaker, we've got our patterns for the smart money reversal occurring. And we've also got our reclaimed order blocks, which I just wanted to highlight here, this candle. Can you see how the bodies close and respect the low of that reclaimed order block? Because reclaimed order blocks are going to show you, going back to the previous slide, where price should likely retrace to. So if we had a gap open below here and we'd closed above this reclaimed order block, maybe this one, whatever, right? You wouldn't typically want to see price come back down into that because you know that this should hold price now, as well as your current PD array too, right? So they can give you a good estimate on where price should and shouldn't come back to, a bit like balanced price ranges. Now, inside of reclaimed order blocks is where you're going to find your reaccumulation zones and redistribution zones, but also having a higher conviction. Like, so in this example, you can see that it did touch back into that fair value gap, but because we didn't close into it, that's going to give you that higher conviction that when this candle closes, you know, this could be the 4 hour chart again. This could be like the weekly, and this could be the 4 hour. And so when this candle closes and you're seeing these respect this reclaimed order block, you know you're going into that next 4 hour candle expecting an open high low close and you're bullish, right? So let's talk a little bit about standard deviations. Personally, I don't use this much. However, it can be very useful in terms of like key profit target objectives. Maybe you want some partials to take and in positions and stuff. And so just to also know, you're going to see this is the exact same chart as well. You know, like every single market maker model has these same, you know, core fundamentals. So we draw our standard deviation from the manipulation leg that occurs to take sell side or buy side. So in this case, we've tapped into our higher time frame point of interest, and it's the high that was made just before it ran lower to take that sell side or buy side. And you can see in this case it is that high there. We then want to draw out 1, 2, 2.5, and 4. And we want to see areas of liquidity line up with this. So look at how clean this is. We've got our consolidation area inside of here that lines up with 2 and 2.5, and we've got a 4. So more than likely you would take profit here and maybe leave a runner up to 4 where buy side is noted. Now there's other ways of using standard deviations. There's symmetrical price swings, there's implied dealing ranges, other stuff which I might make another part 2 for market maker models to go over some more advanced concepts. In fact, I will, because in this video I just want to show a complete slideshow of concepts, and then in the next part, for a part 2, I'm going to go over literal chart examples with on trading view and not be so locked into, you know, fixed drawings. Now, premium and discount, this is a very, very complicated topic where it has an absolute insane amount of value to know about, right? So premium and discount can work typically from external range liquidity to internal range liquidity, and from internal to external. And so price will seek, because the reason this is very important is because this is how premium and discount is created. A valid premium and discount dealing range is only drawn when you have a sell side sweep and a buy side sweep. You have to have both. You cannot just have a sell side sweep without a buy side sweep, right? So that's where your external and then internal comes, which then it comes back down to discount. Look how clean that touches discount to then drive higher. So retracements that touch equilibrium before a continuation are higher probability. So if you were trying to buy in here, you would technically be buying in premium of this range, because this is the low that swept the sell side. This is your dealing range low that you draw it from. Now, The market moves from areas of premium and discount on every single time frame at the exact same time, and that's why sometimes your equilibrium doesn't get hit before it continues. And this is also why you can get easily confused as to what's going on in price. Like if you're waiting for, let's say, from this low to wherever it went up to high, let's go back actually, let's have a look. So let's say you drew from this low here to this high, you were waiting for discount in this leg and it never got touched. You would think, how comes that? And it's because of so many different reasons. Like you might say reclaimed order blocks, you might say it's being held by this, it's being held by that. But in reality, one thing is for certain is that it's doing equilibrium on all of the time frames at the exact same time. And so that's a that's something I'm gonna go into more for part two, because that's a very, very key concept to understand, like, and visualize that the 4 hour might be dropping to come to 4 hour equilibrium. So let's say this leg here is the 4 hour equilibrium. To come down into 4 hour equilibrium, it has to make small retracements higher, and then retracements higher are touching premiums for 5 minute arrays and such things. Now, I'll go into that in depth on another video for sure. Right. Here is some actual market maker model general gems. I've got them just written out. It looks a little bit messy, but we're going to go through each one. So don't try to catch reversals with opposite curve PD arrays. We spoke about that earlier, but the main reason for that is, if you can imagine, right? Let's actually bring up the chart here. So if you can imagine, you're trying to catch the reversal. Let's say you've drew out this as a buy side sweep, and so now you want to go short when this gets swept on the lower time frame. You don't want to do that, because first, the higher time frame bias is bullish, right? You can clearly see that we've made a large expansion higher. And second, it's not confirmed until you go onto the lower time frame. So maybe you did catch a sell here for this Judas swing that dropped lower, because if we see here, right, just on this bullet point, we'll come back to all of these, don't worry. After each premium and discount PD array is touched, price will likely give a Judas or a retracement swing before another continuation. So that is exactly this which is being described, where price will touch, a premium PD array. So maybe, so here's your first, whether it don't matter, it's not in premium, but let's just see actually, is it in premium? It is in premium, right? So discount was like here. So here's your first premium array. So it touches, like maybe your order block. It takes a buy side sweep. Here's your first Judas. You get a Judas lower. Then you touch your next PD array, Judas lower. Then you touch your next PD array and Judas lower. So you can see that these little drops here is what sometimes you'll get confused into thinking it's short, and this is where you're taking your losses. But if you just waited for the opposite and waited for it to come back in for the long and come back in for the long and then come back in for the long, that's where you take your heavy wins. So that's a really important point, to like, don't try and catch reversals. Instead, draw out the continuation PD rays, wait for them to get closed above, and then use them for longs higher. Yeah. So only expect a market maker model to complete slash reverse once it clears its original consolidation or touches premium slash discount PD arrays in the OTE area. So if we know that we're bullish, so let's say our daily time frame is bullish, we know that any lower time frame market maker models under that time frame, so this means the 4 hour, the 1 hour, the 15, whatever, the 1 minute, all these market maker models should be, when they coming back higher, they should be clearing their original consolidations. So this area here, this is where the market maker model is complete. However, if we were trading the opposite direction, so in this scenario we're looking for longs, if we were trading the opposite direction, so we were looking for market maker models that look like this. Okay, so we're still bullish, higher time frame, daily bullish, right? So this is daily, and then here, let's say this is just the 5 minute. On the 5 minute, if we get a retracement into here, right, we're gonna expect that, like, let's say we're trying to short in here, we know that more than likely that market maker model will finish inside this area here and respect it to go higher, as opposed to coming down and taking sell side, because the market higher time frame market maker model is bullish, right? The direction is bullish. Now that's where it's important to like use the lower time frame to confirm that reversal, because you don't know if it's going to take that original consolidation high. Like in this example, we have hindsight to tell us that it did take this buy side high. But what if it didn't? What if actually price price wanted to only come into the OTE premium range and drop lower and take the low again? That's where we would use lower time frame market maker models to confirm. Now, we spoke a little bit about this, so I'm going to skip it, but reclaimed OBs are a great retracement area to expect the next distribution or accumulation. In this one, this is an important note. So in each quadrant of the main dealing range, there is a setup that occurs. So 0.25, 0.5, 0.75. That refers to this. If we were to draw that this is your dealing range, because it's a bit like you need to know your implied dealing range, which would mean that you'd need to know that as price trades, like as price is trading higher, where do you think price is going to get to ultimately? Like your market maker model buy side, not your, okay, I think it's going to go to 44,200. No, like where do you think that daily market maker model, or that whatever time frame you're on, where's the completion for what looks correct? And in this scenario, it's buy side. So you can see I've marked out 0.25, 0.5, 0.75. Every time price goes above one into one of these next quadrants is where you'll get your next setup. So if we go down to the 5 minute, you'll see what I mean here. Price comes above the 2.5 level and we come exactly down and we touch 2.5. So you could have got an entry in here, here, or here. Now we go above 50. Look at what we do. We come back into 50 because look, this is 50 here, right? So we come back into the 50 range. We haven't gone above the 75 level yet, so we're still expecting that this is a decent area to buy in, right? Like it could come down into more of this range. It doesn't have to just touch it perfectly. It could come down into here. But we know this is a good area to buy in because this is where you get your next high probability setup for accumulation. Once we touch and get above this like 7.5 level, so we don't actually get above on this point, which is why we seek back into discount of this leg here. But once we do close back above on different time frames, it will reflect stuff. But here it's quite clear we come back above 75, and look what we do. We respect it and climb higher. We stall until we get up to our terminus, which is our buy side for the implied dealing range. Now, these are two nice, very important little gems that can help a lot with executions and making sure that you get higher probability and better moves. So expect fast and slow price action through areas of high or low imbalances, which sounds fancy, but ultimately it just means this. If we know price has had, let's use a lower time frame for this. If we know price is creating lots of areas of consolidation, so like this, we know that to get back above this is created like a brick wall, because this is hard to get through now. When it's stacked highs, it can be easy, right? So this creates a nice little liquidity run above this, which is only possible once we get past the bulk. The bulk of the volume is drawn by like this. This is like the bulk. So look how long we stay inside that bulk and we don't take buy side. As soon as we get a close above, we instantly pop and take these highs, right? However, look here, we don't have in this entire leg bit down, we don't have much in the way of us climbing higher. So imbalances, we have these fair value gaps, but they're not restricting us in a way like this would here because this has created a large amount of volume. ICT describes it as like fortification. So the more you have this, imagine if you now had to punch your way through that wall. It would be hard because you'd have to go through one, two, three, four, five, six, seven. You'd have to go through all these layers. But if you just had one layer to go through, right? If that was the wall, and I told you to punch it, it'd be easy because it's just one layer, right? Same thing here. So you've got one layer of price action. It's fairly easy. It climbs up quite aggressively. We see that in this area it struggles, and then once we get into this, it soothes out a little bit. And then look at this drop here. This is all like one wall, which it does quite easy work of. We climb quite fast and another fast climb after our accumulations. So that can help a lot for like understanding and expecting different types of price action in market maker models. And the last note is going to be V-shaped reversals. Because we know that V-shaped reversals provide significantly better price runs due to the BPRs it creates. Right, this is a BPR. This is a clean BPR. There's lots of BPRs, but this is just one version of one clean mechanical way to draw BPRs is when you get a fair value gap through a fair value gap. So that creates a BPR, and you can extend it even further, right? Like as you get further, you've got more down here. But specifically, we want to look at smart money reversals that are happening if they're giving us these V-shaped BPRs. So here, imagine this is a market maker model in itself. We've got our low, and then we instantly displace back higher above these imbalances, creating fair value gaps, which gives us our high probability BPR. And then we get a continuation out of that a bit higher. And so you can see this everywhere in the chart. But if you really want to trade the market maker model, format and like a 2022 so ICT model or some kind of breaker, fair value gap unicorn, all of these models themselves all require a very high probability reversal because they're they're all related. So it's very important to look for areas where you've had this sweep. So maybe it swept these highs, right? And then you've had an instant rejection, which creates this V shape in price, because that's going to give you your strong like continuation lower. Like we pop a little bit higher back into that gap, and then that lower. That could have been your settle right there, right? Maybe you took a something like this and 1 to 1.5. Like that could have been your money for the week. So the possibilities are endless. Now let's go to the next slide. What did we learn? There's three main concepts. I could have added so many here, but I think these three are the most important that I've learned for market maker models is that they're fractal, right? They're operating on every time frame at the exact same time, okay? Like as we are creating a 4-hour market maker model to go higher, like okay, so in this leg here, we expect the 4-hour to do something like this, don't like we expect the 4-hour to drive lower into this sell side, don't we? Okay. However, inside this area here, this move up here will have had a, a lower time frame market maker model where we know that this is occurring now just to take this low, which is just the small low inside of a 4-hour, right? Like Do you get what I'm saying here? So market maker models are happening all the time, and even inside this market maker model, inside this little zone here, you've got another mini, you know, it's it's doing the same pattern, right? And so it literally is fractal. It doesn't matter where you're looking at it, but if you can find a market maker model inside of a market maker model, you've got a very high probability trade. Because if your market maker model is the 4 hour and you're trading like the 5, 1, 15 minute market maker model, you've got a high probability trade. Now, higher probability areas of interest contain 3 plus PD arrays. Just look for overlapping areas of interest. This is quite a simple concept, but I think it's overlooked a lot. Mainly, if you didn't want to use 3, at least 2, right? At least a fair value gap and something else, because that creates a higher probability scenario. A fair value gap plus anything is always better. Trading continuations is easier than attempting to predict reversals, tops and bottoms. Like, bro, don't try and catch this fair value gap in here for the sell. You want to be the guy that's okay, look, we're going up, I think we're going to come back down into this and buy. Like, you don't want to be the guy to catch the reversal, but you can. Like, reversals do happen. You would need, in this scenario, I'll explain how you can do it. You need to have SMT. SMT has to be a part of your strategy for this, where if you're trying to catch this reversal here, where you're saying, look, we've got a fair value gap, it's from 20 hours ago, and I'm going to try and catch the long out now all the way up to buy side. In this zone here, because how do you know price isn't going to, right? How do you know price isn't going to give you your little bounce, make you think you're making money, drop again, do another run, or maybe do another bounce, drop again, do another bounce, and then oh, it's going to take the low. I've took 3 losses now, right? That happens a lot. But this is where, if you're very, very confident about, the earlier slides, so we're talking about the smart money reversal, SMT with ES or NQ if you're trading them pairs, and your SMT confluence, where you're getting your, inverse is happening, maybe your CISD, and maybe you're creating a fair value gap as it's expanding higher. That is then going to give you the confidence inside this higher time frame range that this is now the continuation higher. So that's the only time you can do that, is when you really, really know what you're doing. And like we mentioned earlier, if you know that daily time frame is bullish, it is very easy to then look for, if this was a 5 minute market maker model inside the AM session, this is gonna these lows, even if they are equal lows, sometimes this is one more gem that I forgot to add, but market maker models need to leave equal highs and lows. So a lot of the time you're gonna look at price and think, you know oh, we've left, Asia AM session has left equal lows with London, and like, we need to go and take that. No, we don't. Okay, price needs to come up higher and higher and make its top for the market maker model before then it wants to maybe take them long term, like months later, weeks later, days later. Okay, so don't always think they need to be taken just because you found some equal lows, that they need to be taken. The market has to engineer liquidity for the opposing curve, right? And one thing I will note is that, like, in premium and discounts, right, like this is really important, because if you've got your, let's say, so you've got your sell side sweep and you've got your internal sweep for buy side, so now you've got your valid dealing range, right? Let's take off these numbers. If you're looking for 0.5 here, if price comes all the way down here, no, just a small retracement, and then it goes higher, you might be thinking, why is it not come down to discount? And that's because it's not ready yet. Just because it's done one little bit of a leg higher doesn't demand it to come down to discount every single move. Price doesn't do that. Price typically, it might go higher, then it might, and so you keep drawing it, right? So you draw it there now, and then maybe it comes down to here and misses it again, and you're thinking, wow, premium discount don't work. Maybe I should have drew it from that low, but maybe that was the lower time frame market maker model for the OTE. This in here had your market maker model pattern where it came down into OTE, and then now it's expanded higher. Maybe. Or maybe you're just right for drawing it here, and then eventually, after it's done that move, oh, okay, now, so look, it swept the internal. Oh, it makes sense now. Okay, do you see, right? Like, this is how it works. And see, look, you've got your external sweep here, and now you've maybe swept an internal here. So now maybe you draw it again. And then maybe price comes back down now to touch it. And in these runs here, you're thinking, you're scratching your head. Why hasn't it come down to, you know, equilibrium of that leg? And then why hasn't it? Yeah, because, it's not ready yet. And it's happening on different time frames, right? Like this, if this was the 4 hour, inside this 5 minute, inside this leg lower, you're gonna get like the same pattern, right? Like maybe this is what's happening inside this leg. Imagine this one here is the exact same as this. So you're creating a high. It's not touching discount. I swept that low. Okay, now it's touched discount here. Then now you draw it from, this high down to this low. Okay, it hasn't touched discount. And then maybe now it touches discount. So it's given 5 minute premium. No, not discount, sorry. I mean premium on these, sorry. So it's touching 5 minute premiums inside as it's trying to make its 4 hour discount leg get reached. And so that's why I meant in the other slide about how sometimes you can have, no, not sometimes, but all the times you're going to have premium and discounts being hit on different time frames at the exact same times, you know, because they're doing different things. And so it's your job as a trader to be like, you know, analytical about what's actually happening and figuring out, it's touching this premium for the 5 minute, but it's trying to touch that 4 hour discount. So then you want to try and sell. Right. Anyways, I really hope you learned something from this. I'm definitely going to make a part two. I've got so much more knowledge I want to share on this, and the concepts can get deeper. Like, the, I've tried to make this nice, visually for people to learn. If you're a beginner, advanced, I don't know, doesn't matter. But there is more to learn, and there's more for me to share, which I'm definitely going to do. So I hope you liked it, and like, look, thanks for watching. For more information, you can join my free Discord, right? Like I'm here, I'm trying to give out some real key information for free. I want to build a community of like-minded people. Like, I'm invested, I'm passionate about trading. This is crazy. Like, I've been doing this for so many years now. I'm really happy with what I'm doing, my progress, everything. I want to help other people. I want to share experiences, whatnot. Like, if you want to talk, you want to ask questions, you can join there. I'm basically just live streaming my screen every single day, and yeah, maybe you can learn something too. But either way, yeah, thanks for watching the video, and I hope you learned something. Take care. Peace.